Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell, and stocks are lower as Microsoft's plunge weighs on the S&P 500 and NASDAQ. Very own Jared Blickery standing by with all the headlines. Jared.
Thank you, Josh. If you're just looking at the quotes right now, it doesn't look that bad, but it was kind of scary in the morning. Here's the Dow. And by the way, the Dow wasn't doing too bad. It was really centered in tech, the sell-off. But you can see in this chart, we started out green. We're down 111 points right now, but at the lows, we're down over 3 times that. And right now, it's about just off of 1/4 percentage point. Here's the NASDAQ. It was down well over 2.5%. It was the worst day in month at the lows there. A big part of that is played by Microsoft. We're going to take a look at that stock in a second. Still down 1.4%, but a lot better than it was looking earlier in the morning. And the S&P 500 down about 0.6%, and similar looking chart started off just barely in the green, but thoroughly in the red now. And meanwhile, small caps, Russell 2000 down just about 0.2 percentage point there. I will show you what's going on in the bond market. 10-year T-note yield down of 3 basis points to 4.22%. And the 30-year now down to 4.85%, down 1 basis point. U.S. dollar index just barely negative on the day. And let's check out the NASDAQ 100. I'll go to the sectors in a second, but I want to show you what's happening with some of the earnings stories today. Microsoft down 12%, worst day in months. Meta up 10%. Best day in months. And Microsoft is part of the tech sector. Meta is not. It's part of communication services along with Alphabet. And let me just show you what's going on with communication services. It is up 2.4%. That is the best day in months. Also a record high for the sector. I haven't seen a record high since last year. In second place, we got energy, then we got real estate, all of those up more than 1%. And then here's to the downside. We got tech 2.4% down, followed by consumer discretionary. And let's just peek inside the software sector. So aside from Microsoft, we do have a lot of red here. Oracle down 4%. SAP, that's another earnings story. That's weighing on the sector. That's down 16%. Salesforce down 7%. So a lot of red on this board. In semiconductors, not a whole lot better, though we do have some green and not as much dark red. But still, the tech has been really facing the brunt of the selling today. And we're seeing that in some of the chip stocks. ARM down to about 3%. So is NXPI and Marvell Tech. Well, I'm going to leave you off on the Dow, and we can see, aside from the mega caps there, we do have some green. IBM, that's another earnings story. That's up about 4%. Mentioned Salesforce before. Energy, a leading sector. We got Chevron up 1%. And some of the staples doing well. Walmart and Procter & Gamble doing pretty good. And JPM in the green for 1.8%. And I'll send it back to you, Josh.
All right, Jared. Thank you. Well, Microsoft shares pulling broader averages lower as investors grow more concerned about AI spending. Joining now to discuss the outlook for the AI trade, we've got Patrick Lyon, Madison Investments Chief Investment Strategist. Patrick, it is good to see you. Maybe start off on these big tech earnings, Patrick. I'm just curious broadly, what some of your takeaways have been. We had big tech reports. We got another one after the bell today, of course, with Apple, but you've seen the reports and some wildly divergent investor responses. If you look today to Microsoft and Meta, of course, what have been your big picture takeaways? What's at stake for the broader market?
Yeah, well, first, thanks for having me on, Josh. When you look at the biggest picture, mind you, I'm not a tech analyst, but just kind of in looking at what happened with Meta and Microsoft overnight, it seems as though the focus, clearly the spend is still very, very big, but maybe the focus turned to revenue growth expectations and the outlook for revenue growth. It was much better for Meta. Maybe that looks like the AI spending is paying off. That's why you see a big boom there. Microsoft, you had a few more questions around, cloud revenue growth, along with, is their AI spend panning out? I can't say for certain that's what it is, but on a 30,000 foot view, that's kind of what the tea leaves tell you right here.
One big picture kind of storyline, Patrick, was interesting heading into the earnings season was, that the Mag 7 really had to hang in there. And if they didn't, then the market would be in trouble. But, if you looked at the Mags, Patrick, the ETF that tracks the group, I mean, it's been going sideways for months, really since September, and the market was hanging in there. I'm just curious what you make of that, what that suggests to you.
Well, for us, that's healthy. I mean, that was one thing we've been looking for, is that you can get to this market where some of the air will come out of that Mag 7 area, or the top 10 of the S&P, and the market or broader market continue to go up. So you've had things, just as you mentioned, over the last 3 months, that Mag stock ETF has been pretty sideways. You've seen better performance in small caps, mid caps, commodities, international equities. So it's really, as a multi-asset guy, it's fun to see multi-assets outperforming. It gets a little bit more boring when everything's just kind of honed in on 7 to 10 stocks. So to us, it's healthy. It's a broadening of the market. The market's looking more towards, continued economic growth for 2026. And to us, we like to see it.
You mentioned the small caps there, Patrick. Edging lower today, but you look at the IWM, that's already up about 7% this year, and it sounds you like this, like you like the small caps.
We do. I mean, we came into actually last year, so I mean, we were about a year early in positioning, a little bit more down cap. Obviously the tariff situation kind of spun that out of control, but with continued, liquidity being pumped in there, the Fed obviously ended quantitative tightening in December, moved actually into buying securities again. So you have liquidity at the back of small caps. You have lower front end interest rates. We've decreased interest rates by nearly 2%, 1.75% over the last year and a half plus. Certainly, that's supportive for small caps. The One Big Beautiful Bill Act also helps small businesses a little bit more than large businesses. So it's an area we like, and it's an area that's been that we've taken up in our own multi-asset portfolios last year and continued to drift a little bit higher as the year closed out.
Talk about the American consumer as well, Patrick. Get your thoughts there, because we got that January consumer confidence number this week. You saw that. That was not good. Lowest level, I think, since 2014. But you highlight here, listen, you say retail sales have been solid. You note some tailwinds like the lower gas prices. I'm curious, what do you make of the American consumer? What do you see ahead? What's the smart way to invest in that theme?
Well, just the comments on the consumer. I mean, clearly there's a dichotomy between what the consumers are saying in confidence reports, what they're saying about the labor market, and then obviously what we're seeing in spending and consumption certainly continue to be quite strong. It is a nominal world, so clearly that helps that we've had the inflation that increases the nominal retail sales. But overall, consumers continue to spend. We think they're likely to continue to spend given the outlook for a stronger economy, and we are seeing incremental growth, at least, and more optimism on small business hiring. So I think that's another area that argues for being a little bit more down cap. But overall, the consumer, it's hard to kind of equate with what they're saying versus what comes out in terms of spending. Obviously, it's very bifurcated between higher end consumers and low end consumers, but clearly the high end consumers are ruling the day at this point in time.
At that Fed presser yesterday, Patrick, Jay Powell fielded a lot of questions. There were some questions he didn't want to get into. I mean, you heard him. He wasn't about to get into politics. A wise move. The dollar, though, he didn't take the bait on the dollar either. He said, "Listen, we do monetary policy here." But yeah. I am curious to get your thoughts on dollar weakness. What's driving it? What does it mean for investors, Patrick?
Well, what's driving it, I think you go all the way back to 2022. You have the weaponization of the dollar during the Russian invasion of Ukraine. And clearly, people outside the United States have to question, the access to their reserves. Is the U.S. a good partner? Do I want to have excess assets in what appears to be an administration that does at least condone a weak dollar or is okay with a weaker dollar? So I think it's definitely something that captured everyone's attention last year as it helped drive outperformance on the international side. But to us, we're certainly going to see bouts of dollar strength, especially if the Federal Reserve would have to, go on to an extended pause, or if inflation were to, turn around later this year, and the Fed may have to entertain a hike, which is obviously an outside the box thing to say. That could increase the dollar. But right now, we're positioning portfolios to take advantage of dollar weakness. It's gone pretty far, pretty fast. We saw this last week, took another leg down over the same type of geopolitical concerns, and obviously what was going on with the markets in Japan. So to us, again, dollar should be a tailwind for kind of investing overseas and looking for other kind of weak dollar plays, and we've been taking advantage of that in our portfolios.
Final question, Patrick, just sticking with the Fed here. I don't know if you saw this. President Trump saying today he will announce his pick to be the next chair of the Federal Reserve next week. Any thoughts there, Patrick? Any bets you want to place? Maybe someone you prefer? Reader, Waller, one of the Kevins?
Yeah, I don't know if I want to make a prediction there. Too hard. It changes too frequently. I just want to make sure that we have someone in there, obviously, that's not going to be something that brings independence further into question. I mean, one of the big outliers for the coming years is, we need to keep long-term interest rates relatively stable, hopefully to incrementally down. Anything that would be viewed by the market as potentially to kind of put a thumb into independence would certainly be something that I think could cause, rate volatility to rise. It's not something we saw, and we don't want to see that come back in terms of rates higher, dollar lower. Clearly, that's a bad recipe for all markets. You can ask Japan about that just over the last weekend.
Patrick, great to have you on the show. Thank you, sir.
All right, thank you.
Lawmakers once again racing against the clock to pass a funding bill before Friday night's government shutdown deadline. Here with the latest on a potential bill, our very own Ben Werschko. Ben, how close is Congress to a deal here?
Yeah, we're getting closer. There's a lot of negotiations happening, and there's movement. But in the last 24 hours, I think we've seen developments that have simultaneously made a short shutdown this weekend more likely, but a kind of more clear off-ramp to how this ends by Monday or early next week. On the sort of short-term front, there was a procedural vote in the Senate today that fell short. 8 Republicans joined with 43 Democrats to oppose this measure to begin debate on passing 6 appropriations bills that would fully avert a partial government shutdown. That fell short, so that's on ice for now. But on the other hand, you've seen the White House clearly engaged here with Democratic objections. The big objection here is the Department of Homeland Security's funding. The White House is clearly talking to them. President Trump said today he's looking for a bipartisan deal to get out of that. The framework we're seeing here is that 5 of these 6 bills kind of get cleaved off into their own thing, and that is able to be finalized by early next week. And then the Department of Homeland Security kind of becomes its own debate on its own. These 5 bills, if they go through, combined with everything that's been passed before, marks about 96% of the federal government by funding level. So it's the far and away the lion's share of the U.S. government here, and sort of nearly everything of interest to the markets that would be enacted if this deal goes through. The Bureau of Labor Statistics, the IRS, things like that would be funded through this. But there's a lot of steps between there now, here and there, details we worked out on this Department of Homeland Security funding. And even if they were to announce kind of a deal and President Trump were to endorse it this afternoon, it would take days to get this through. That's why we're sort of very likely to have a shutdown this weekend before the House of Representatives comes back on Monday, probably at the earliest.
Before I let you go, Ben, another big story on your radar. Oil prices surging to a 4-month high here. President Trump threatening to take action against Iran. What's the latest there?
Yeah, so tensions are definitely high there in the region. That's partly because U.S. military assets are now in sort of what's known as striking distance. So there's an aircraft carrier and multiple warships in the Middle East if they're needed in terms of this standoff between the U.S. and Iran. President Trump reiterated his threats last night in a True Social post. He described it as a massive armada in the Middle East now, and he said that they could act with speed and violence if necessary. So clearly, kind of a lot of saber rattling on that front, and it's a very unpredictable situation. I think that's sort of partly why you're seeing the energy market response here, because Iran is clearly destabilized at the moment after weeks of protest and a violent putting down of the protest from the regime there. So that both sides, it's kind of unpredictable what's going to happen. I will say there are signs of diplomacy clearly still to play out, likely in the days ahead. Both Israeli and Saudi Arabian officials are reportedly in Washington to kind of lend their insight into these talks. Saudi Arabia has clearly got a big interest in de-escalating tensions if they can and trying to find a diplomatic off-ramp here. What Trump is demanding is that Iran come to the table to talk about its nuclear program. Exactly what shape that is remains to be seen. But clearly a lot of talks still to play out. But again, the military officials and soldiers are in the region, so there could be action.
All right, Ben, thank you. Appreciate it. Mm-hmm. Coming up, software stocks are sliding. Are investors right to fear the impact of AI on the sector? We get an analyst take on this next. AI disruption worries flaring up once again, especially for software stocks. The overhang from Microsoft weighing on the sector, plus SAP's disappointing guidance. Even ServiceNow could not escape the AI worries, and that was despite its stronger than expected sales outlook. Joining me now is Wolfe Research Managing Director and Head of Software Research. That would be Alex Zukin. Alex, it is always great to see you. So let's talk about these software names, Alex, which you know so well. They are getting whacked today. I'm just looking at the IGV here, so that's the software sector ETF, deep in the red. Microsoft, Salesforce, ServiceNow, they're all down hard. I have had analysts on the show, Alex, financial analysts like yourself, they cover software. And kind of big picture, one thing they've suggested is that investors have simply decided, they say, Alex, that the AI story is playing out in chips. It's playing out in some social media names. You can see the reaction, of course, say in Meta. It's not in software. That's what they've decided, and so they're out. What do you make of that?
I think that is exactly what is happening. I think that, days like today where a name like ServiceNow, which objectively had a pretty good quarter, is being used as a selling opportunity. A name like Microsoft, where they missed maybe some investor bogeys. It's rare when a company loses $300 or $400 billion of market cap on $700 million of delta in revenue. Those are rare experiences. So I think you're absolutely right to say that investors are voting with their feet, and they're going into sectors where the growth is more obvious to see, and they feel like there is durability. We disagree. We think that while it is maybe harder to see, it will come. It will take a longer period of time, and sometimes that's okay, because when it takes longer to get in, it can be more durable. There's a lot more complexity associated with enterprise data, governance, security, compliance, risk. And we think that some of these trends and themes can play out over a longer period of time, and we're still in phase 0 of adoption. So we think that patience can be rewarded. There's some really interesting buying opportunities, particularly on the consumption side, where we think AI budgets, AI demand is dragging up a lot of opportunities for growth at names like the data platforms like MongoDB, the data warehouses like Snowflake, the observability vendors like Datadog, as well as some of the communication platform companies like Twilio, that are all being kind of taken down today in sympathy with some of the other software names.
Let's talk about some places where you see opportunity, Alex, because listen, you know these names so well, and so I'm just very curious to get your take on the report. Microsoft, for example, which is getting nailed today, Alex. The spending continues. Capital expenditures for Q2, nearly $38 billion. That exceeded what the street penciled in. Meanwhile, Azure jumped 38% when adjusted for currency. That just met analyst predictions. Copilot, so it's AI assistant, 15 million users. Maybe some folks were hopeful they would see more there. And I wonder, do you think what's going on is just big picture with Microsoft, Alex? Folks are wondering, where is the payoff, Satya Nadella, for all this spend?
So it's really interesting. I think Microsoft is a very large and complicated business, but investors like to boil things down into something simple, which is there a part of the business that's really exciting, that's accelerating growth, that can drive the rest of the business to accelerate as well? And for a long time, that has been Azure. And Azure has been growing, and it's the 5th straight quarter of kind of high 30s growth. And a year ago, if someone would have told people that that's the growth rate, they would have been really, really surprised. I think right now, investors were very surprised that instead of accelerating growth, Microsoft made the kind of unique decision to allocate scarce resources to their own products and their own research efforts at the cost of acceleration. And so it's just a really unique phenomenon that folks haven't really seen before to this degree and magnitude. I think it's the right decision for the business. I think Microsoft feels like, look, we've got 15 million Copilot seats. We've got 450 million Office user seats. If that's a 3% penetration for a technology that we think is going to be the cornerstone to the future of how people work, because today it's a Copilot, tomorrow it's a coworker, as some wonderful LM companies are demonstrating for them. And we can't lose, we have to win that battle. We have to win that ground. And that is a higher margin business for us overall longer term. So their view is, if we can divert, we're in a GPU constrained environment in terms of how much capacity we can bring up. If we can kind of divert more resources there, we can get a much better holistic kind of AI driven business over the long term, as well as on the research side, where we think they will and are working on some of their own proprietary frontier models that will ultimately increase their competitive positioning vis-a-vis companies like Google.
Alex, you mentioned ServiceNow, and I do want your take on that one too, because you look at that sales outlook in the current quarter, it was stronger than predicted, Alex, but again, clearly just plenty of investor skepticism about the AI strategy here. I know you tell your clients, listen, this one's a buy. How come?
Look, we think at some point, companies will start to see more agents being adopted inside of the four walls, accessing privileged information, interacting with all manner of critical systems. And at that point, there's going to need to be a platform that, IT and technology leaders trust, depend on, to manage, control, and shape how those agents are working. Today, we have IT departments for people that use technology. Tomorrow, we're going to have IT departments that manage the agentic spread and kind of swarm happening in companies. And we think ServiceNow is extremely well positioned to do that. They have done a few large deals over the course of the last few months that I think spooked some people. We think that they have kind of taken the necessary pills to expand into other markets and other adjacent opportunities, as well as amplify some of the innovation that they were driving internally that's going to unlock accelerating growth. And quite frankly, investors are saying, if you're not accelerating at a time when you're telling us the markets are expanding, you're spending so much money, industry writ large, on capital expenditures to grow this pie. If you're not accelerating now, something's wrong. And we think ServiceNow is going to accelerate. I think the other element that people want to see is really margins and margin leverage. If we're adopting all of this fancy AI technology internally to drive more efficiency and productivity, where's the proof in the numbers? And so accelerating growth, improving margins, and sometimes even inflecting margins, I think is what investors need to see. We think ServiceNow is going to deliver that over the next 12 months, and we're using today's opportunity as a buying opportunity.
Another buy you got, Alex, and I'll end here, Salesforce. Now this one, we're down about 40% over the past 12 months. What does Mark Benioff, Alex, what does he need to say and do to convince investors, you know what, his stock is a smart opportunity?
Accelerating growth and improving profitability. I think that similar to ServiceNow, the last 12 months have seen Salesforce embark on some large-scale M&A that they've done, at a time that was considered to be a little bit surprising for the markets. I think they've undergone a full strategic pivot around Agentforce, this agentic AI platform that they believe is the future of apps, and we would agree. So we think concrete examples where customers have adopted, not just adopted, but are actively using and paying for this technology, and it is additive, accretive to the growth rate. If they can lay that out, that this is, again, we've turned the corner on the growth, and we are back on a pathway that leads to something that's closer to double digits over the course of the next year or two, and not just in words, but in concrete proof in the bookings growth rates of this business. I think that's what investors are going to want to see, because there's a lot of companies that are private directly in the space that are putting up some serious points on the board that, quite honestly, are frightening from a competitive perspective to institutional investors.
Alex, good to see you as always. Thank you.
Thanks, Josh.
Coming up, I speak to a strategist who sees Fintech as a top area of opportunity for investors. That's next on Market Domination. Now time for some of today's trending tickers. We're going to start here with Royal Caribbean, the company reporting fourth quarter results mostly in line with estimates. Meanwhile, earnings guidance topping the street's expectations for the first quarter and the full year. The cruise line noting it has about 2/3 of 2026 capacity booked, adding that it continues to see elevated close-in bookings. Next up, Caterpillar surpassing Wall Street's estimates for fourth quarter revenue and earnings, driven by the power business. The industrial giant's backlog growth in particular catching the attention of analysts. Barclays knowing the backlog and new order growth in one quarter are figures they have not seen in this industry before. Caterpillar highlighting it's entered the new year with strong momentum. Oppenheimer pointed to guidance implying momentum into this year. And lastly, Comcast reporting an earnings beat for the fourth quarter. Company pointing out that domestic wireless delivered its best year, while free cash flow turned out being double than estimated. But KeyBank seeing a challenging competitive broadband environment, painting a mixed picture on the company's earnings report. Well, President Trump making efforts this week to pitch Americans on his plans to improve affordability. But as an investor, how should you be thinking about it? My next guest recently authored a note highlighting which stocks could be winners in this environment. And joining me now, we got Drew Pettit, Citi U.S. Equity Strategist. Drew, it is great to see you. So let's dig into this report, Drew. At a high level, you're pointing out here, listen, populism is on the rise. It's certainly true. Politicians on both sides, obviously very laser focused on affordability, the issues of economic anxiety. I guess at a high level, though, Drew, walk me through how that policy shift, how and why, Drew, it favors fintech.
Yeah, it's funny. So super high level to really kick this off. We like financials. We actually feel pretty good about the economy. So credit, we think, holds in there. We think the consumer does prove to be resilient again this year. With that in mind, that should be a good backdrop for all financials. But when you move away from deregulation, which really helps bigger, more established companies in space, down to policy tweaks, changes, populism, that actually helps disruptors and faster moving companies. And those that are really trying to get at inefficiencies in the system, that's fintech in a nutshell.
So, Drew, if that's sort of the thesis, then how do you screen for that, Drew? How do you screen for this kind of this fintech populism play? Like, what are the variables, the metrics you're plugging in?
Yeah, it's funny. This is a lot of reading through documents. It's really digging into what these companies are trying to achieve. And when you think about this, there is actually old school fintech, which honestly, just credit cards and payments in the background, that's fintech, but that's almost old fintech. New fintech is about what fees are between me and you, or me and a business, or me and a financial institution. Who is trying to actually lower that cost or cut out some of those steps? So that's number one. And then number two, if we're really if we're trying to juice the economy, push up affordability, help the consumer in a midterm election year, I want someone that's playing to small and medium term businesses or retail directly, because they're going to see the biggest tailwinds. So to us, like, it was those two things. Who's your target market, and what is like your actual goal of your business? Is it to disrupt and drive efficiencies?
Were there certain fintech subsectors, Drew? I'm just curious that, screened particularly well, like under the hood. Was it payments? Was it BNPL?
Yeah, so BNPL, Affirm, Klarna really kind of stood out. Again, alternate means of getting credit. Then when you think about digital assets as well, just the idea of digital assets was about populism in the financial system. And again, more efficiency working on digital rails, not the current system we have. So that gets you to, something like a Circle, a Coinbase, a Bullish. And then even as you go down the list a little bit further, you start thinking about disruptive lenders in the space like a SoFi. And I see you guys have the CEO coming on tomorrow. So all of these are, again, decent sized companies. They're disruptors to the incumbents. That's really key to us. A lot of these are running on technology rails, not traditional systems.
Yeah, I'm just looking through some of the winners your team of very smart analysts picked out here. There's Affirm. I see Intuit there, Drew. HubSpot, mixed list, Coinbase. Many investors, Drew, when you talk fintech, they think, okay, immediately your head goes to regulation. Was that, is that a risk I need to consider in my fintech populism playbook, or no? Maybe I'm thinking about it incorrectly, Drew. Maybe you would say, hey, that's a potential positive. That's a potential tailwind.
Yeah, so you got to think about this in two spaces. Number one, there was sell-off when we started talking about the credit card rate caps and interchange fees. That hit the BNPL names. Initially, they kind of traded up that day and then got weaker throughout the day. But actually, it's a lot easier for a fintech who's already trying to take share and price aggressively to change their pricing structure. So I think the market may have kind of over traded that negative news flow. And then on the flip side, for some of these businesses, especially in digital assets, increased regulation basically says our business is real. It affirms that they should be around. And we're moving away from, I would say, enforcement world where the SEC comes after you if you do something bad in digital assets and move too quickly, to a regulation world, which if you're already in the space, you know how to operate, you can adjust from there. So regulation is actually good for digital assets and some of these newer companies.
You know, Drew, you do mention here how this basket, you say it is high beta compared to other equities. So there could be viewers watching this, Drew, and they're thinking, you know, I like Drew's idea here, but I'm concerned maybe about volatility. I mean, how would you imagine, Drew, that this kind of fintech basket would just sort of fit into a broader, diversified portfolio?
Yeah, it is definitely a satellite position. These aren't core holdings. But if you have a bullish thesis around the consumer, you're going to get these volatility bouts where you can buy into the basket. Today's a really good example. The other day when we had weakness on consumer confidence, if you think that is moving past, then these are the better leverage ways to play it. The way I'd think about it, because they're relatively high beta to traditional financials, instead of buying $1 of financials, you might be able to buy 50, 60 cents of a fintech populism basket like we put together. So again, smaller dollar amount probably gets you kind of similar overall exposure in beta. So to us, if you got conviction in the trade, you probably need less fintech to get exposure to it.
Finally, Drew, what would you say, you know, the big risk or risks I have to think about with what we're talking about here? I mean, one I would think, but tell me if I'm way off, would be what if, Drew, you know, all this hot political talk, and there's been a lot of it, but what if it doesn't, at the end of the day, Drew, translate into any real hard, concrete policy action?
So it's funny you mentioned that, because even without the policy action on credit card caps, you started seeing some companies make some announcements and consider some moves in the background. Even without moves on interchange fees, that is now in CEO suites, like that is being discussed. These types of actions, whether it's the Republicans or the Democrats, if we're going down a populist path, you don't necessarily need regulation. You just don't want to be in the crosshairs. So you're going to get and elicit a corporate response just by putting these companies in the headline. So to us, you don't necessarily need regulation if the tone stays around. But at the end of the day, if it drives the consumer forward, it ends up increasing liquidity in the system. The fintech names are probably your biggest winners, more so than consumer and traditional financials.
Drew, always a pleasure to see you, my friend. Thank you.
Okay, take care, Josh.
Coming up, Starbucks announcing some changes to its rewards program. Going to bring you the details. That's coming up next. Starbucks is brewing up plans for long-term and sustainable growth. At its Investor Day, CEO Brian Niccol lays out the next phase in its turnaround effort. And Yahoo Finance's Brooke DePalma was there and here now with the takeaways. Brooke.
That's right. What we really heard from Brian Niccol was really this emphasis on growth for Starbucks. When he initially joined back in 2024, he had pulled back the long-term guidance for the company, and now he's really reintroducing it for the first time to the investor community. What initially they had announced is this growth plan over the next 3 years, taking us through fiscal 2028. Within that plan, the company said specifically that they plan to grow both global and U.S. comp growth, same-store sales growth, about 3% over the next 3 years, about at least that much, and that will lead to what you see on the screen here, revenue growth of about 5%. Also, in addition to that, they aim to see operating margins between 13.5% to 15%, and also adjusted earnings about $3.35 to $4. Now, keep in mind, in addition to that, they also said that they plan to open new stores. They plan to add about 2,000 net new stores across the globe, including both company-operated and licensed operated over the next few years through fiscal 2028. And then he hopes to get to more of a regular cadence of about 400 new stores every single year. Also, Josh, keep in mind that this guidance that they put out includes their China business, which now they have a joint venture with over there for about $4 billion stake in the company that they had announced last fall.
What about changes to the loyalty program, the menu? What's going on there?
Yeah, well, that's really what consumers care about here, right? So typically they had this reward system, but now they're introducing this new sort of level system. And what exactly it is, it actually kind of gives a little bit of omen to that old gold card, if any of you out there have that. Now there's 3 levels. Green, so typically, what you join with there, the basic one there. Gold, if you have 500 stars over the course of a year, you'll be a gold member. And then this reserve member, you have to earn 2,500 stars. So I don't know exactly how frequently or how much you have to buy per year to get 2,500 stars. But with that, you will get a physical Starbucks reserve card. It's like this black card similar to that gold card that they had a few years ago. And then also there's other perks, like you can have 7 days instead of just the 1 day to claim your free birthday gift. So, hey.
So it's updating products and services. What about the overall look? What's going on there?
Yeah, well, the overall look here is expected to be more of like that coffee house vibe. So when you sort of walk in, this is a video that I took at the Investor Day today. There's going to be words on the outs. One of them is even like pup cup or cappuccino, latte. It's expected to have 2,500 new seats added within the stores. They also plan to take away comfier, or rather add more comfier seats and take away uncomfy seats. In addition to that, you see that condiment bar to the left-hand side when you walk in. Brian Niccol really emphasizing the need for that. They also just initially overall, they plan to renovate 1,000 stores by year end, and they already did 200 so far since, I understand, since Brian Niccol sort of led this coffee house culture feel. But keep in mind, this is not just a new coffee house, not just a new look and feel. They also have a new innovation coming out. Brian Niccol really doubling down on protein, so keep a look on that. And they're really trying hard to compete in the afternoon. So expect more there, including these new energy refreshers. So just really trying to compete with other up-and-comers like, say, a Dutch Bros.
All right, thank you, Brooke. Appreciate it. Well, Chili's parent company, Brinker, is extending its strong turnaround in the casual dining space. Yahoo Finance's Julie Hyman sat down with CEO Kevin Hochman to break down the company's second quarter earnings report.
It's a lot of it is the same old things that we've been doing. We've been laser focused on the fundamentals of casual dining, improving food service and atmosphere. And that's exactly what we're doing every quarter. So, this quarter we had several food upgrades. We did more simplification in the restaurants. More of the investments continue to kick in. We had record food grade scores, record guest metrics going in. And that continued throughout the entire quarter. And then we wake up and we do a +9 on top of a +31 the prior year in the quarter for a 2-year cumulative stack of 43. Things are going really well at Chili's, and I don't think that's going to stop.
Well, and that's sort of my next question is that 31 to 9 is a slowdown, but 9 is obviously still really good, especially in this environment. That slowdown, is that sort of is 9 sort of the natural resting rate, if you will, or do you expect a little bit more of a deceleration just because you have grown by so much in Chili's for so long?
Yeah, the way to think about it is, we had many quarters of double-digit growth, and so the whole big debate about our stock and our company was, are we going to be able to roll the +31s with positive traffic, positive sales, because that's the real test of whether that was a blip or this is a sustainable turnaround. And the reality is, +9 is probably at the very top of most comp store sales in the restaurant industry. To do that on top of an additional blowout quarter, just makes it incredible results that the industry has never seen. Several of the analysts, several of the folks that cover the industry and restaurants are saying this is the best turnaround of all time, not because of the numbers, but because it's so sustainable. 19 consecutive quarters of same-store sales growth and a ton of traffic growth as a part of that driver. That's why it's sustainable.
I mean, are the comparisons going to get tougher at some point, or are you guys sort of mapping that out and managing expectations around that?
Well, the comparisons are tougher right now, right? So the peak of our turnaround right now has been 2 consecutive quarters of +31%. So that happened of Q2 last year and Q3 of last year. We have now successfully hurdled the first hurdle of +31 with a +9, and then we're in the second quarter or Q3 where we had another +31 last year that we're very much on track. We talked about this in our earnings call. We were doing mid single-digit same-store sales growth heading into the storm. The storm obviously stopped that for a few days, but we are very confident we'll get right back to that. And we talked about having positive traffic in February, positive traffic in March, and we expect positive traffic in Q4 to have another blowout year.
Kevin, you talked about the fastest growing customer category is households earning under $60,000. We know those households are challenged in many cases right now. So how are you thinking about that? Are you really, do you have to be creative to keep those people coming through the door? Is that going to create margin pressure for you guys if you're offering, a lot more promotions, for example?
Well, we've been winning with all guests, including the low income, for a long time now. It's been behind our $10.99 3 for Me combo meal. And basically you get almost a half-pound burger, fries, unlimited chips and salsa, and bottomless drink, all for $10.99. And when you compare that to what you can get, at a fast food joint, it's very competitive from a price standpoint. Sometimes it's actually under where you could get in a fast food joint. Certainly the abundance is considerably bigger than most of the meals that are out there. So, we feel like we have superior value. But on top of that is when you actually come to the restaurant, you get an amazing service and hospitality experience, and you're doing it in a fun atmosphere. And I think that's the key. It's not just the price point. We're not the lowest price point out there, but in terms of the total experience and what you get versus what you pay, I don't think there's anybody that can beat us, and that's why we continue to lead the industry in growth.
And I know on the call, a lot of people, you talked about that $10.99 price point and that you have a lot of items available at that price point. How sort of committed are you to that price point? Are you going to have to raise prices on some of those $10.99 items this year if we see, for example, commodity prices continue to go up?
Yeah, we have what's called a barbell strategy. So we have obviously a very varied menu in casual dining versus like a QSR. So the actual $10.99, the mix of $10.99 is quite low. So it's about 9% of tickets, less than 5% of sales, right? So we have a lot of different options within the 3 for Me value lineup as well as outside of that. So no matter where you shop the menu, you're going to get great value. So like, for example, take margaritas. If you only want to spend $6 for a premium margarita, we have our Marga of the Month. This month, it's the $6 Resolution Breaker. But if you want something a little bit more premium, you can get our Casamigos or our Don Julio, and that's going to be, closer to $10 to $15, right? And the reality is different guests have different needs. So that guest that only wants that hot price point, there are things for them. But the reality is most people actually buy other things on the menu.
Kevin, Chili's, as I said, has been doing great. Maggiano's, not so much. So how do you apply that Chili's playbook to Maggiano's, and how quickly do you expect to see better results there?
Well, it's exactly the same playbook. We got to get back to great food, great hospitality, and great atmosphere. And a lot of the same challenges we have at Maggiano's that we had when I started at Chili's. We've got to make sure the menu's nice and tight, and we're doing things scratch made, and they're incredibly abundant so that the guest sees that value. We were able to increase portion sizes of pasta by 20%. This quarter, we saw value scores actually start to creep up as soon as we did that. So we feel very good about that. From a service standpoint, we got to get more efficient and quicker. People, they want to eat within an hour, hour and a half. If you go to a more polished casual like Maggiano's. And then we got to make sure we are upgrading the restaurants, both in terms of the repairs and maintenance on the restaurants that were deferred during COVID that we've now fixed on Chili's. We need to do the same thing on Maggiano's. And then we have to start to get into re-imaging. We've done about 5 or 10% of the estate of Maggiano's today. They look amazing, and it's going to be a more relevant brand going forward. On Chili's, it took about 7 quarters to really turn the traffic growth. So this is not a simple process. I wish it was just a magic bullet that these brands can take and turn them around. But you got to put the hard work in. We got to put the investments in. But I'm confident we're going to see a turnaround in that brand too.
I'm also curious if Maggiano's is a little bit the victim of some of the more prevailing forces. In other words, pro-protein, maybe not as much noodles, carbs, And so I'm curious across the portfolio how you guys are adjusting to that protein push, the GLP-1 effect included. Like, are we going beef noodles, Kevin? Is that where we're headed?
Yeah, I'm a firm believer that we have to focus on the things we're really great at. Like these brands didn't become like legendary and iconic and be around for 4 or 5 decades, because they were chasing trends. They typically are things that they're known for. So like on Chili's, we talk about the five to drive. So things like triple dippers and fajitas and margaritas, that's what we're known for. And when you're craving those things, that's why you're going to come to Chili's. Likewise at Maggiano's, you're looking for those amazing, classic Italian-American favorites that you love, like chicken parm and fettuccine Alfredo and chicken piccata and baked ziti. And, you're not going to necessarily, run to those restaurants if you're looking, to change your dietary habits and be super high protein. There are restaurants that do a great job of that. But when you want to have amazing indulgent meals at great affordable prices, abundance that you can have seconds the next day, that's the types of things that people come to us for. That's what we got to lean into. That's obviously been working for our company the last 3 years, and that's how we're going to continue to have success with our brands.
All right, no pasta made of beef. Check. At least not for now, Kevin, which is fine with me. Great to see you. Thanks so much for being here.
Hey, thanks so much, Julie. Great to see you too.
Take care.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Follow the closing bell. Stay tuned for Market Domination Overtime.